Welcome to the deep dive. It's pretty striking when you hear that statistic, something like, what, 60% of new businesses, they actually start with less than $5,000.
It really makes you pause, doesn't it? Especially when you've been learning about entrepreneurship, you hear so much about, big funding rounds.
Totally. It kind of challenges those initial assumptions about needing massive capital right out of the gate.
It does. And digging into that kind of foundational understanding is exactly what we're aiming for here on the deep dive.
Right?
So our mission today is to really unpack the core ideas behind financing new ventures and also crafting those effective business plans.
And this isn't just a quick review, is it? We're aiming for that deeper grasp, like for someone prepping for an entrepreneurship exam, needing that cognitive level 5 understanding.
Precisely. We want to get beyond just what the concepts are and really explore the why. We're using notebookentrée.pdf as our guide here, trying to connect all these pieces for you.
Okay, let's do it. Let's start with financing. The notes jump right into a big one. Information asymmetry. What's the core issue there when a startup's looking for cash?
Well, fundamentally, it's about what each side knows. The entrepreneur, they're living and breathing this venture, right? They know the market nuances, the team's real strengths and weaknesses, the tech.
They've got the inside track.
Totally. Way more than any potential investor can realistically figure out from, a pitch deck and a few meetings.
And this knowledge gap, it creates problems. The notes list 3 main consequences. First one seems obvious. Investors are making calls with, well, incomplete data.
Exactly. It's like trying to bet on a horse race, having only seen one horse trot around the paddock. You lack the full picture, the context.
Which makes judging the real potential, and maybe more importantly, the real risks, super tricky.
Absolutely. And that leads right into the second consequence. The potential for entrepreneurs to, well, maybe not be entirely forthcoming.
You mean taking advantage of what the investor doesn't know?
It's not necessarily malicious, but the structure allows for it. An entrepreneur might, consciously or not, emphasize the good stuff and maybe skim over the potential hurdles, painting a rosier picture.
Okay, and the third one mentioned is adverse selection. The notes don't spell it out, but am I right in thinking this means investors might end up attracting more of the less good ventures because they can't easily tell them apart?
That's a great way to put it, yeah. Because it's hard to differentiate the truly great ideas from the ones that just look great on paper. Investors might find their pool of applicants skewed.
So the weaker ventures might be louder or more aggressive in seeking funding because, well, they need it more.
That can definitely be part of it. It highlights why investors need really robust ways to sift through and evaluate these opportunities carefully.
Okay, moving beyond just the info gap, the notes talk about uncertainty problems. It's not just what investors don't know, but the fact that it's all, well, new.
Exactly. You're asking someone to put money into something with basically zero track record. It's all projections, market guesses, belief in the team.
So, judging based on very little hard evidence.
Right. And then there's the problem that even with the same limited info, the entrepreneur and the investor might have wildly different ideas about what the venture is actually worth. How do you value potential?
Yeah, that valuation piece is always tricky early on.
And finally, because of all this uncertainty, investors naturally want some security. They often look for collateral, something tangible to back the loan or investment.
Which is tough for a lot of startups, especially tech or service ones that don't have many physical assets.
Precisely. It's a major hurdle.
So we've got information asymmetry, we've got inherent uncertainty, big challenges. How do we solve them? The notes suggest a few routes. First up, self-financing or bootstrapping.
Ah, yes. The big advantage here is obviously control. You answer to no one, keep all the equity, all the future upside.
Total autonomy sounds good.
It is, but the massive limitation is usually scale. How much can you realistically fund yourself? It might really cap your growth or slow you down.
And you're carrying all the risk personally.
Every bit of it. Plus, you miss out on the expertise, the network, the sort of validation that can come with outside investors.
Okay, so bootstrapping has its place, but limits. What about using contract provisions? These sound like the legal tools to manage these risks. Let's break them down. First, covenants.
Covenants are essentially promises baked into the investment agreement. They're rules the entrepreneur agrees to follow.
Like what?
Well, they can be positive things you must do, like provide regular financial updates, or negative things you cannot do without investor permission, like taking on huge new debt or selling off key assets.
So they're guardrails, basically, to protect the investor's money.
Exactly. They directly address that information asymmetry risk by putting limits on what the entrepreneur can do unilaterally.
Okay, next up, convertible securities. These sound interesting for dealing with that early valuation headache we mentioned.
They really are quite clever. Things like convertible notes or preferred stock.
Right.
Essentially, they let you postpone the hard valuation discussion.
How does that work?
The initial investment act's kind of like debt. It might accrue interest. But the key is it converts into equity later, usually when the next proper funding round happens.
Ah, so you value it based on what the next investors think it's worth? Maybe with a discount for investing early.
Precisely. Or sometimes there's a valuation cap agreed upon upfront. It lets investors get in early without getting bogged down in maybe speculative valuation debates, and entrepreneurs avoid potentially giving up too much equity too soon.
Smart. Okay, what about forfeiture and anti-dilution provisions? Sounds like more investor protection.
Definitely. Forfeiture is often tied to founder stock vesting. If a founder leaves too early, they give up or forfeit some of their shares. Keeps them committed.
Aligns incentives. Makes sense. And anti-dilution.
That protects investors if the company later raises money at a lower valuation, a down round. Their ownership percentage or conversion price adjusts, so their stake isn't unfairly diluted by the lower price.
Got it. Then there are control rights. Who gets to call the shots when outside money comes in?
Yeah, this is crucial. Control rights specify what decisions investors get a say in. It could be major things like selling the company, or it could mean getting seats on the board of directors.
And the level of control depends on the deal, the risk.
Exactly. It's negotiated. Investors want enough oversight to protect their investment, especially given the risks we've discussed.
And lastly, under contracts, vesting periods. We hear about this for employees, but how does it work for founders and investors here?
It works similarly for founders. Their own equity stake often vests over time, maybe 3 or 4 years. You don't get it all on day one.
So again, it incentivizes sticking around and building the company.
Absolutely. It ensures everyone with a significant stake is committed for the long haul. It's less common for the investor's initial cash to be tied to vesting, but some rights might vest over time or with milestones.
Okay, those contractual tools are key.
Yeah.
The notes also mention specialization in investing as a solution. How does focusing help investors?
Well, if you specialize, say, only in biotech or only in seed-stage SaaS companies, you develop really deep knowledge of that specific area.
You understand the jargon, the market, the pitfalls.
Exactly. It cuts down that information asymmetry significantly because you know the right questions to ask, you have relevant benchmarks, you understand the specific risks and opportunities.
That makes sense. Specializing by industry or even by the stage of development like seed versus growth stage.
Right. Each stage has unique challenges. Seed investors are good at evaluating raw ideas and teams, while later stage investors are better at assessing scalability and market traction.
The notes also touch on geographically localized investing and syndication. What's the advantage there?
Local investing leverages proximity. You understand the local ecosystem, the talent pool, maybe have better networks, you can meet face-to-face more easily.
More hands-on potential. And syndication. That's multiple investors pooling resources.
Yeah, a group of VCs or angels invest together. This spreads the risk. No single fund has too much exposure to one company. It also allows for bigger investment rounds.
And you get multiple sets of eyes doing due diligence, potentially more expertise around the table.
Exactly. It brings diverse perspectives and networks, which can be hugely beneficial for the startup too.
Okay, so lots of ways to manage the risks. Now let's switch back to the entrepreneur's perspective. The notes pose 3 critical capital questions. First, how much money is needed? And there's that stat again, 60% need less than $5. What's the real point here for someone starting out?
The key takeaway isn't just that you might need very little, but that you need to figure out exactly what you need, rigorously.
So really map out those startup costs, legal fees, equipment, first hires, marketing tests.
Everything. And project expenses, until you realistically expect to be bringing in enough cash to cover your own costs. Underestimating is a classic and often fatal mistake.
And having that detailed breakdown shows investors you've actually thought it through.
Absolutely. It shows where their money is going and what milestones it's supposed to help you hit.
Okay, question 2. Where should I get that money? The notes list everything from savings, friends and family, angels, VCs, banks, government programs. How do you choose?
It really depends on, your stage, how much you need, how much control you're willing to give up, what kind of support you need beyond just cash.
Right, different sources bring different things to the table. Angels might bring mentorship, VCs bring connections for growth.
Exactly. And different costs of capital. Debt needs repaying. Equity means giving up ownership. There are trade-offs with every single source. You need to weigh them against your specific situation.
And the third question loops back.
hmm
What type of arrangements do I need to make? This sounds like the contracts again.
It is. It's about the structure of the deal. Is it debt? Is it equity? What are the specific terms, the covenants, the conversion features, the control rights we just talked about?
So understanding those details is crucial before you sign anything.
Absolutely paramount. The wrong deal structure can hamstring your company later on.
Okay, let's say you have a handle on your needs and potential sources. The notes move to financial analysis tools. These seem vital for planning and for talking to investors. First, the list of startup costs and use of proceeds. Why is this basic list so important?
It's foundational. It itemizes every single expense to get the doors open and operational. Then, the use of proceeds part tells investors exactly how you plan to spend the money you're asking for.
So clarity and transparency. We need X dollars, and here's precisely where it's going. Y for marketing, Z for product development.
Exactly. It builds confidence that there's a clear plan for deploying their capital effectively.
Next, pro forma financial statements. For that level 5 understanding, we need to get beyond just knowing what they are. What's their real purpose?
Pro formas are your projected financials, income statement, balance sheet, cash flow, usually looking out 3 to 5 years. They're forward-looking guesses, essentially.
Guesses based on assumptions about sales, costs, market growth.
Right. For the entrepreneur, they're a vital planning tool.
Yeah.
You model different scenarios. What if sales go faster, slower? What if costs are higher? It tests the viability of your business model.
And for investors.
For investors, it's how they assess the potential return. They'll scrutinize your assumptions, run ratios, see if the projected path to profitability and positive cash flow looks realistic and attractive.
Which brings us to the next point, emphasized quite strongly in the notes. Cash is more important than your mother. Hyperbole maybe, but it hammers home the importance of cash flow statements. Why is cash the absolute king for startups?
Because profit on paper doesn't pay the bills. You can be technically profitable recording sales revenues, but if your customers haven't actually paid you yet, and you have salaries and rent due now, you're in trouble.
Right. Cash flow is about the actual money moving in and out.
Exactly. A cash flow statement tracks that reality. It shows if you can actually meet your short-term obligations. Startups often fail not because the idea is bad, but because they simply run out of cash.
And the notes mention how to get from net income to actual cash flow, adding back non-cash expenses like depreciation, adjusting for changes in receivables, inventory, payables.
Those adjustments are key to understanding the real cash position. Managing working capital, the money tied up in receivables and inventory versus what you owe suppliers, is critical.
And the notes give tips. Collect receivables faster, keep inventory lean, control spending, maybe stretch out paying your own bills a bit.
All practical levers you can pull. Managing cash flow effectively literally buys you time to grow, time to reach profitability, time to secure the next funding round if needed.
Makes sense. Okay, another tool, breakeven analysis. What does this tell everyone involved?
Break-even calculates the point in terms of sales volume or revenue, where your total revenues exactly equal your total costs, the point where you stop losing money but haven't yet made a profit.
So it tells you the minimum you need to sell just to survive.
Precisely. It's a fundamental measure of risk. How far are your projections from that break-even point? How much cushion do you have? Investors look at this closely to gauge how realistic profitability is. It also shows how sensitive your profit is to changes in sales or costs.
Very useful. Now, the notes tackle the big debt versus equity financing choice. Can you quickly define each and explain why startups usually lean towards equity?
Sure. Debt is borrowing money you have to pay back, usually with interest on a fixed schedule. Think loans. Equity is selling ownership slices stock in your company in exchange for cash. Investors become part owners.
And startups prefer equity because?
Primarily because early on, they often don't have reliable positive cash flow to make those fixed debt payments. Missing a loan payment can trigger default, which can be fatal.
Debt adds pressure when things are already uncertain.
Exactly. Plus, traditional lenders usually want collateral, which startups often lack. And some argue debt can incentivize founders to take excessive risks to generate cash quickly to meet payments. Equity aligns investor and founder interests more towards long-term value creation.
Though the notes mention some debt types might appear later: personal guarantees, asset-based lending, supplier credit.
Correct. As the business matures, generates revenue, acquires assets, some forms of debt become more accessible and appropriate, often supplementing equity. But for that initial high-risk phase, equity usually dominates.
Okay, so if equity is common, let's look at investor perspectives. What are VCs, venture capitalists, specifically looking for?
VCs play in the high-growth space. They're looking for ventures in potentially huge markets, ones with a strong, defensible competitive advantage, maybe unique tech, a powerful brand, network effects.
Something proprietary.
Often, yes. They need to see a clear market need being addressed and, critically, an experienced, credible management team that can actually execute the plan. And importantly, a plausible path to a big exit, an IPO or a large acquisition, so they can realize their return.
High growth, big market, strong team, exit potential.
Got it. And more generally, what do most investors focus on? The notes really boil it down to two main things. First, an excellent venture team. Is the team motivated, passionate, honest? Do they have the right experience? Investors bet on people, fundamentally.
The jockey, not just the horse.
You got it. Second, an excellent business opportunity. Is the market large enough? Is the strategy sound? Is the product or service compelling? Is there a real, observable, competitive advantage?
Team and opportunity. Makes sense. So if an investor is interested, what's the typical investor process? Notes mention due diligence, staging, and rate of return.
Right. Due diligence is the deep dive the investor does after initial interest. They verify everything: the business model, the financials, the legal setup, customer references, the team's background. It's intense.
Baking the tires thoroughly.
Very thoroughly. Then staging. Investors often don't give you all the money at once. They release it in stages or tranches tied to you hitting specific milestones.
Why do they do that?
It minimizes their risk. They can see progress, gather more information, and confirm the venture is on track before committing the next chunk of capital. It keeps everyone focused.
And rate of return. That's what they expect back.
Yes, their expected return on investment. And crucially, the required rate of return is heavily influenced by the stage of the venture. Earlier stage, higher risk.
Means they need the potential for a much higher return to compensate for that risk.
Exactly. A seed investor might look for 10x or more potential, while a later stage investor might be happy with 3-5x because the business is more proven.
The notes also briefly outline the venture capital method for evaluation. Can you walk through the steps?
Sure. It's a way VCs estimate what ownership they need for their investment. Roughly, 1. Forecast the company's likely earnings or revenue in an exit year, say 5-7 years out. 2. Estimate what the company might sell for then, often using a PE ratio from comparable public companies.
Right.
That's the terminal value. 3. Discount that future terminal value back to today's value using their high required rate of return. 4. Divide their investment amount by that present value to figure out the percentage ownership they need to achieve their target return.
It's a methodical way to work backward from a potential future exit.
It is. It's heavily assumption-driven, of course, but it provides a framework.
And finally, on getting funded, the notes mention encouraging investors' impression management, urgency, framing, and a good business plan. Seems like salesmanship comes into it too.
Oh, absolutely. You need to project confidence, professionalism. Sometimes there is genuine urgency, a market window, a competitor's move. Framing the opportunity persuasively is key. And all of it needs to be backed by that solid, credible business plan.
Which brings us perfectly to the second half, developing effective business plans. Chapter 10 in the notes really frames this as the essential roadmap.
It absolutely is. The chapter outline hits all the key points. Why plan, the pitfalls, what it actually is, who benefits, how to evaluate one quickly, how to write it, and what needs to go in it.
Let's start with the importance of planning. Seems obvious, but what makes planning effective according to the notes?
It's not just having a plan, it's about the quality. Effective planning needs realistic goals, specific, measurable, achievable, relevant, time-bound, SMART goals.
Not just vague ambitions.
Right. It also needs real commitment from everyone on the team. And clear milestones, intermediate steps with deadlines so you can track progress and adjust if needed.
And on the flip side, what are the big pitfalls to avoid? Things that sink plans.
The notes list several common ones. Setting no realistic goals in the first place. Failure to anticipate roadblocks, just assuming smooth sailing. A lack of commitment from the team. Not demonstrating relevant experience, and trying to be everything to everyone, having no market niche.
Yeah, those sound like they definitely undermine a venture.
They often do. Good planning anticipates these.
So what is a business plan, officially? The notes define it quite broadly.
It's described as a comprehensive written document. It outlines the venture's current status, its goals, its needs, and its projected results. It covers everything: product, market, operations, team, financials, risks.
It's the whole story, laid out logically.
Exactly. It serves as that roadmap for the entrepreneur internally, but also as the primary communication tool for outsiders, especially investors.
What are the specific benefits of a business plan for the entrepreneur first?
The process itself forces you to be critical and objective. You have to research your market, analyze competitors, really think through your strategy. It helps you quantify your goals so you can actually measure success later.
Turns assumptions into concrete plans. And for outside evaluators, like investors,
For them, it's the key document for assessment. It shows the market potential, your plan to capture it, how you'll generate returns or repay debt, how you've thought about risks. It gives them the core info they need to decide whether to invest.
the notes have this interesting concept, the 5-minute reading. A quick way to assess a plan.
Yeah, it's like a quick triage. In 5 minutes, you should be able to grasp what's the basic venture and industry, what's the financial structure look like, how much are they asking for, a quick glance at the balance sheet if they have one, who's the team, what's the unique angle or feature, and just get an overall feel for professionalism and clarity.
A first filter.
Yeah.
Makes sense. And then there are the basics of putting the package together: appearance, length, cover page, executive summary, table of contents. Presentation matters.
Absolutely. A sloppy, overly long, or poorly organized plan sends a bad signal. Keep it concise. Make it look professional. The executive summary has to grab them. The table of contents needs to be clear. First impressions count.
And some guidelines to remember when writing. Keep it short, organized, future-focused. Avoid hype. Be honest about risks. Showcase the team. Define the target market clearly. Write in the third person.
All good advice. It boils down to clarity, credibility, and professionalism. Avoid exaggeration. Investors see through it. Be realistic about challenges. Focus on the team's strengths and the market opportunity.
Okay, let's get into the actual elements of a business plan. Section by section. Section 1, Executive Summary. What's its job?
It's the most important part, arguably. It's a brief overview of the entire plan. It has to cover the core concept, the problem solution, the market, the advantage, the team, the key financials, and the funding request. It needs to be compelling enough to make someone want to read the rest.
Your 30-second elevator pitch, but written down and maybe a bit longer.
Kind of, yeah, but comprehensive.
Section 2, Business Description. This goes deeper into the company.
Right. General description, the industry context, the company's specific goals and milestones, its potential, and what makes its product or service unique. It lays the foundation.
Section 3, Marketing. This is split into resource analysis and the marketing plan itself.
Yeah, first you show you've done your homework. Target market identified, market size and trends understood, competition analyzed, realistic market share estimated. Then you lay out your plan based on that research. Product strategy, pricing, distribution channels, advertising, promotions, how you'll actually reach and win customers.
Makes sense. Research first, then strategy. Section 4, Operations. Location, supplies, transport. The practical stuff.
Exactly. Where will you be located and why? What are the advantages? Zoning, taxes, talent pool. How will you get your supplies? How will you move goods or deliver services? Shows you've thought about the day-to-day logistics.
Section V, Management. All about the team.
Yep. Who are the key people? What's their background and expertise? What's the legal structure of the company, LLC, C Corp, etc.? Who's on the board? Who are the advisors? Again, investors invest in people.
Section 6, Financial. The numbers part. Projections, cash flow, break even.
This is where you back up the story with figures. Detailed forecasts, P&L, cash flow, the break-even analysis we discussed, how you'll control costs, your budgeting process, needs to be realistic and well-supported.
Section 7, Critical risks. You have to talk about what could go wrong.
Absolutely. Good plans identify potential problems, market changes, competitor actions, operational issues, and discuss potential obstacles, and, importantly, contingency plans or alternatives. Shows you're realistic and prepared.
Section 8, Harvest strategy. How do investors get their money back eventually?
Right. What's the end game? Selling the company, going public, IPO, management buyout. Investors need to see potential exit routes to realize their return. Shows long-term thinking.
And finally, Section 9's milestone schedule. tying objectives to timelines.
Exactly. What specific measurable objectives will be achieved by when? What are the key deadlines? How do different activities relate to each other? It provides that concrete action plan and timeline.
And the notes wrap up, Chapter 10 mentioning the presentation of the business plan. Knowing your stuff, rehearsing, using keywords. It's not just the document, it's the delivery.
For sure. A polished, confident presentation of a solid plan can make a huge difference in convincing investors or partners.
Wow, okay. We have definitely covered a lot of ground there.
Mm.
From the nuts and bolts of venture finance dealing with information gaps and uncertainty through all the funding options and analysis tools.
And then connecting that directly to how you build a robust business plan that actually addresses those investor concerns and lays out a credible path forward.
It really shows how interlinked these two areas are. You can't really have a good funding strategy without a good plan, and the plan needs to reflect the realities of the funding environment.
Absolutely. And mastering these concepts, understanding the why behind them, is so crucial, not just for, passing an exam, but for anyone actually wanting to launch and grow a business.
Definitely. So maybe a final thought for you to chew on as you continue studying. Think about how fast things are changing. Technology, funding models, even customer behavior.
Right.
How might this increasing speed and constant evolution impact how you need to approach financial planning and business plans in the future? Do they need to be even more agile, more adaptive?
That's a really important question. Maybe revisit your notes. Look at some recent startup case studies through this lens. How are they adapting their funding asks, their operational plans, their market strategies on the fly? Consider the strategic choices real entrepreneurs are making right now.
Good advice. Well, this has been a really deep dive into financing and planning. We hope it's given you a much clearer, more connective understanding as you prepare.
Yeah, best of luck with your exam prep and any future ventures.